You're listening to Between Two Bridges, a business-to-business podcast. With your hosts, Anthony R. Destiny, Joe Ferrani, and Jerry Kenna. Interviewing entrepreneurs, business operators, and investors. This episode of Between Two Bridges is sponsored by Paymark Payroll. Payday is the most important day to your most important people, and payday is made easy at www.payyourpeople.com.
Alrighty, we're here with a bonus episode of Between Two Bridges.
Oh, I like the bonus
Little
episode.
bonus for our business
Little
owners.
bonus episode.
Yeah,
In fact, it's one thing to start a business. It's another thing to go legit and actually pay taxes on that business and be on paper. I may know some people that are under the table, I guess you could say. But here at the man, the myth, the legend, Jerry, who has filed millions of tax returns.
Maybe not millions, but
millions of dollars worth.
Hundreds of thousands.
So I would say I've probably done myself probably about 20,000 tax returns.
Joe, how many have you done?
I haven't done a tax return in a long time. Jerry's I'm part of that 20,000. The last time I did do a personal tax return, though, it was funny because it's when they came out with the app where you just took a picture of your W-2.
Yeah.
And I think I still owe Oakmont taxes from that one.
Still didn't do it right.
So
Yeah.
don't use Joey. My grandma filed mine until I hired Jerry. So shout out, Graham. But here to discuss some common myths or loopholes, positive or negative for your business.
Yeah, we'll talk about some.
Yeah.
I'm gonna burst some bubbles today.
Yeah.
Oh, yeah.
But I'm also gonna give some
Helpful tips
and like that.
So I know for Oakmont, Verona, surrounding areas, one of the things that we get involved in, or at least support from a community perspective, is the U.S. Open, right?
Yep.
So every 8 years, 10 years, what is it, Joe?
I think it's going to be 6 moving forward after this year.
We get it every 6.
Yeah, they've picked a couple courses and they're in
Yeah.
a circuit now instead of having all these places. They've run into some problems over the years. They've gotten first time venues that have turned into shit. So
Yeah.
they're going to stick to the basics. And Pennsylvania, I think, has 2 of the venues, and one is Oakmont. So,
But was on the Tiki Talks the other day and had this idea that I could rent my house out for the U.S. Open, go to Cuba or something while Tiger Woods rents my house, and I get all this income for free. Jerry, is that true?
So yes, that is true. So there is a rule in the IRS section 230A. No, I'm sorry, 280A. That is commonly known as the Augusta rule. So it's the same concept. In Augusta, Georgia, small town, similar to what we deal with here.
Yeah.
Where a lot of the locals have to leave town and get the hell out of there because of the tons of people that come for the
annual Masters.
The annual Masters tournament. So what happened was a lot of people rent out their house for that time, and it just a weekend or a week long. Sometimes corporate people will come in for a full 2 weeks, but there was complaints that I rent out my house, now I've got to report that as income, and now I've got to pay taxes. And so what the IRS did is they decided that if you rent your house for 14 days or less in a year, you do not have to report that income. It's called the Augusta rule. Now, what you probably saw on TikTok and what has become this extremely common misconception with the Augusta rule is that now I can take my corporation and rent my house to myself and then take the deduction on my corporate return, but not show the income on my personal return. And you'll see all these people on TikTok and YouTube and all these people that are saying that you can do that, you can get away with that. And on paper, it sounds nice. It's not true. Anybody that's gotten away with it has just not gotten audited yet. You have to be really careful with that. If you're renting it to yourself, you are considered you're not independent. You can't rent it to yourself and then claim that deduction. It has to be a separate party. It cannot be. Now, I could rent Joe's house for a week and pay Joe, and that would not be income for you.
Okay.
But I could write it off.
What about an Airbnb for 14 individual days?
As long as you don't rent it out for more than 14 days. I don't believe that it says anything about the number of guests. It's just 14 days or less.
Okay.
But you have to stay under that 14 days, and then you can basically take that income without paying any taxes on it, reporting it as a rental property. But there's a lot to this misconception. There's a lot of things that could get you jammed up if you try to do this deduction. First of all, if you are a sole proprietor, an LLC that's a disregarded entity, so you're filing on your personal return, you can't rent from yourself,
right?
Because you are a sole proprietor. It's you. So even if you, for instance, if you owned a law firm and you were a Schedule C sole proprietor and you bought an office, your law firm cannot write off rent paid to your office because you're a sole proprietor and your office is owned by you. So it's still just you. So you have to depreciate it. You have to put it on the books. Even if it's owned by two separate disregarded entities, it's still considered you. They're disregarded. You are the entity. So it's like trying to take money out of your right pocket, put it in your left pocket, and calling it a deduction. It's not.
Right.
Oh, you can if you have a TikTok accountant.
If you have a TikTok accountant, yeah. But it always, I have clients that'll send me videos like, "Hey, is this true?" And I've heard some crazy stuff on TikTok, and I don't know. I would be worried about putting stuff like that on the internet that eventually I'm going to end up getting in trouble. Just be careful who you're taking tax advice from.
Yeah.
But no, the Augusta rule is in fact a real rule, but it's designed so that you can rent your house for 14 days or less per year without paying taxes. The idea that you can pay yourself rent from your corporation, that is false. That is a myth, and if you were to get audited, it would get thrown out.
Yeah, they rent. I'm sure those houses down there in Augusta rent for big money, but right. You can get an egg salad sandwich on the grounds for like $1.50.
Oh yeah,
beers are like $3. They make enough money on the advertising and the merchandise sale that they don't need the money from the food.
Yeah.
So
that's any individual, or do you have to be a business owner to take advantage of this?
Oh, any individual. In fact,
anybody in Oakmont, Verona could rent their house. 14 days around the U.S. Open, pocket that money.
Yeah. I had a client one year that rented it out to American Express.
Oh. And
for 14 full days, they know the drill. They were there for 14 full days. They paid him a very healthy sum of money, tax-free.
Boom.
Nice. So the other thing I'll hear a lot, and this isn't just on TikTok, I've heard it my whole life. You have a good year in business, and the business owner's driving a new truck, and they'll say to me, well, my accountant told me I had to buy a vehicle or I had to buy something to offset some of my costs. Yeah,
so there's a couple layers to this question. So the big thing is with the Trump tax bill in 2018, Tax Cuts and Jobs Act of 2018, they redefined something that was already in the tax code called bonus depreciation. Bonus depreciation allows you to take more depreciation in the first year of certain assets so that you can offset your income in that first year. Prior to the 2018 tax bill, the bonus depreciation was 50%, and it there were some other rules too, like it had to be a new asset. So if it was a used truck, you couldn't do it. And there's some other limitations that I'll get to that. But the 2018 tax bill took it up to 100%. You were allowed to write off 100% of your asset purchase up to, and it could be anything. You could take 50, 70, whatever, but up to 100% in that first year, up till 2022. 2023, it went down to 80%, and it's going to go down 20% every year until it's phased out completely in 2027. It'll be zero. It'll be gone unless they redefine the law. Now, that's one side of it. So you have the bonus depreciation. Now, there's good parts to that and bad parts to that, because there's also another part of the tax code called a Section 179 deduction. That's been there forever. And that allows you to also take 100% of certain assets in the first year. The difference between the two is if you take a bonus depreciation can actually allow you to take a loss. So if you have a $50,000 profit, you buy an $80,000 truck, you can write off, theoretically, $80,000, show a $30,000 loss, which then could potentially be used to offset other income and help with other income and bring your tax liability down. A 179 deduction, however, cannot take you to a loss. It'll take you to zero and nothing further. For any of our listeners that are in Pennsylvania, though, Pennsylvania will recognize a 179 deduction. They did not recognize a bonus depreciation. So if I took bonus depreciation on my truck on my federal return, I still had to depreciate my truck for 5 years on my PA return. So it kind of created two separate depreciation schedules. But if you do a 179, you could do it on both.
Okay.
So there's a little bit of differences to that. But the nice thing about that is that it wasn't just limited to vehicles. Leasehold improvements, it's basically any asset that has a 20-year or less life. So if you have a building that you rent and you're doing leasehold improvements, furniture, fixtures, computers, anything that you're buying, you can take in that first year to help offset. So that's what you're getting whenever you're sitting down with your accountant at the end of the year and in November, December, and you're looking and like, okay, well, here's my profits. What can I do to help alleviate my tax liability? And your accountant says, well, what kind of equipment do you need? Do you need a new vehicle? Do you need some computers? Do you need some tools? That's why, because we're trying to work in that bonus depreciation Section 179 world where we can make a big impact. And the nice part of that is with a truck or a vehicle, a lot of people are financing them. So that's a way that you can take that big deduction without actually coming up with the cash.
Yeah.
Right. So you buy a truck, you finance it in December. You've not paid anything for that truck, but you're going to take that $80,000 write-off and save yourself on taxes. Now, the bad side of that is that truck's gone now on your books, written down, and you're making payments for the next 6 or 7 years of your life. And the only thing you can write off going forward at this point is your interest on the loan, maintenance expenses, fuel, stuff like that. But the depreciation part of it's gone. Now, with the bonus depreciation in 23 and forward, you would have whatever percentage is left. So if I can take 80% in 23, then that other 20% gets spread out. The other thing, talking about trucks and vehicles, to keep in mind is that the IRS has limitations on how much you can depreciate in 1 year if you buy a vehicle. And the reason they did that is they're trying to prevent people from
buying G-Wagons.
Exactly. Buying ultra luxurious vehicles and writing off these ultra luxurious vehicles unnecessarily. Yeah. Right. The G-Wagon is actually the loophole though, because the limit, the way they did it is, so first they did that. They said, well, if they created these limitations, these annual depreciation limitations. For instance, 2023, you're only allowed to take $12,200 in that first year, unless you're doing a bonus depreciation, then it goes up to $20,200. But if you're at $12,200 times 5 years, you're looking at like a $60,000 vehicle. Right. If you're buying an $80,000 vehicle, like you go out and you buy a a 5 Series BMW that's $75,000. Now you can't write it all off in 5 years. You've got to carry it forward as long as it takes to get it written off.
Yeah.
So you're limited. So what happened was a lot of people came to the table and said, listen, I have to buy this truck. These trucks cost me $90,000, $100,000, these work trucks. And now you're telling me I can only write off $12,000 in a year. This doesn't work. So the IRS said, okay. If it has a gross vehicle weight of 6,000 pounds or more, there's no limitation. So any full-size truck, most SUVs, vans, that's the loophole. So I don't know what, off the top of my head, what the gross vehicle weight of a G-Wagon is, but I would imagine it's over 6,000 pounds.
Okay.
So that's why a lot of these manufacturers aren't dumb, right?
Yeah.
So I had a client last year that called me and said, hey, I'm going to buy a Chevy Blazer. Does that qualify? And at first I'm like, I don't know, it's a kind of a small SUV. I don't know. Gross vehicle weight, 6,001 pound.
Oh,
Like, GM's not dumb.
okay.
You know?
Okay.
You know, so you have to keep that in mind too. Now, the other side of that is if you're gung-ho on buying that sedan and it's not going to be, the gross vehicle weight's not there, or you want a mid-sized truck or something like that, then that's why a lot of these people lease.
Yeah.
Because leasing is a different thing. You're not actually depreciating the value. You're writing off the lease payment, kind of just like you're renting a car.
Yeah.
So you're just writing off the payment straight. There's no limitations. So that's why you'll see a lot of people, if they're driving sedans, small trucks, they'll lean on leasing versus buying.
All good information there.
Yeah. So one more thing I wanted to talk about, and then we can maybe do a rapid fire. Can I write this off?
Yeah.
But as part of that bonus depreciation, something that has become really, really popular, like I've said in other episodes, I'm a real estate investor. A huge part of my client base is real estate investors, and I think a lot of them are listening to this podcast pretty regularly. So something that's become very popular are what's called cost segregation analyses. Basically what that is if you buy a building, say for instance you buy a commercial building and you buy it for just say $1 million. Okay. So depreciation rules with the IRS says that it's a commercial building. By standard, you take that $1 million purchase price and you divide it by 39 years. That's the useful life of a commercial building. So you take $1 million, just for simple math. Take $1 million divided by 39. That's what you're going to take as a deduction every year for that building. So what the cost seg does is a cost seg allows you to go and do an analysis of that building. So you send in an architect or an engineer, and they go in and they say, okay, well, it's $1 million, right? But the doors are worth this much money. The flooring's worth this much money. The electrical work's worth this much money. The plumbing's this much money. And he breaks down every single little component of that building. And what they can do is they can say, all right, so of this $1 million, 300,000 of it should be a 39-year life. But we think that 300,000 should be a 10-year life, and 200,000 should be a 15-year life, and they break it up into pieces. Now, what that does is on its surface is it allows you to accelerate the depreciation, right? Because now instead of taking $1 million divided by 39, you're taking 300 by 39, but then you're speeding up the depreciation on all those other components, right? Well, that's good in itself because you're getting all that benefit up front. Mm-hmm. But then the Tax Cuts and Jobs Act kind of took that to another level, because now any of those assets, any of those segregated components that are less than a 20-year life can now be bonus depreciated. Okay. So now I can take that 300,000 that was a 10-year life, I can write it all off in the first year. 300,000 gone. So if I'm flipping houses and I happen to buy this commercial property and I've got $300,000 worth of profits on this side of the business, but I bought this commercial property, I can wipe out that profit by doing a cost seg and accelerating the 10-year part of the life. So that's become a really popular thing to do. A cost seg, you're hiring an architect, right? Or an engineer. It's going to cost you probably $2,000-$3,000, depending on the building. It's going to cost you some money. But that report that they give you, when you take it to your accountant, they're going to do that for the depreciation, figure out the best way to use that report. And if you get audited, that's what you're going to give to the IRS. And they're going to go, all right, well, I'm an IRS auditor, but this guy's an engineer, so he would know.
You can't just walk in and be like, yeah, it's $100.
Yeah, no. When they first
ain't paying no $10,000 for that.
When they first did it, they didn't specify who could do it. They actually allowed accountants to do the cost seg. And then I think they realized that we have no idea. So they specify that you have to have an architect or an engineer sign off on it.
You're like, this building is not worth shit, but this copper wire is worth $1 million.
Yeah, it's been real beneficial. I've used it for some clients. I have a client that was able to get employee retention credits and significant amounts. And with that, those employee retention credits, what a lot of people don't realize is that you have to go back and amend the year that they came from to show that income. They're not just free money like some of the other grants. So we were looking at like, holy shit, we are going to have a lot of tax liability here because he's this client has a high tax rate. And I thought, well, did they buy that building that they're in that year? Yeah, they did. So I called my engineer.
Yeah.
We did a cost seg, and we actually made it so we could wipe out that extra income and make it so that it was tax-free.
So when you do that, then moving forward, you write off half of the price. You write off $500,000. Moving forward, you're going to depreciate the $500,000. Do you have to? What then are your liabilities like moving forward so you don't get that?
Yeah. So first of all, you can do it a couple different ways. You can go by the cost seg, right? You can do it where the rest of that $500,000 is broke up into whatever categories, like 15-year, 10-year, 20-year, 39. Or you can say, you know what, I'm just going to be conservative with the rest of it and go all 39 and just stretch it all out. You can do either way. But then the other part of it is the downside to it is if you sell that building, when you sell a building and you make a profit, a lot of people think, oh, well, I'm going to have to pay capital gains. There's another piece to that puzzle. Okay, so any depreciation you take over the time that you own that building, you have to recapture that. Meaning, if you took $500,000 worth of depreciation, just let's use that example. So you bought the building for $1 million. You've owned it for 3 years. You took $500,000 worth of depreciation. You sold it for 1.2, right? So there's two different pieces of taxable income here. First of all, the 1.2, that 200,000 is your profit, right? That's your capital gains. By definition, capital gains. That's either, according to the current tax code, it's either 15 or 20%, right? Well, the other piece of that puzzle is you have to recapture the $500,000 worth of depreciation, and that's taxed at ordinary tax rate. So you're actually going to pay taxes on $700,000. $200,000 is going to be taxed at either 15 or 20, but the other $500K is going to be taxed at whatever your income tax rate is. And with a $500,000 income, it's probably going to be 35%.
Yeah.
So, this cost seg works really well for long-term purchases. If you're looking that you're going to have this building gone in 5 years, probably not a great move because you're going to end up paying more in the long run.
Yeah. Sometimes it's better to pass the buck down the road, though.
Yeah, yeah. But a lot of times, like when I'm doing a cost seg, these are long-term investments. These are people that are planning to have the building 10, 15, 20, 30
businesses
years.
Are running inside them.
Right. Or they're rental properties and they're long-term assets.
That's going to bring up probably my favorite thing we've ever done. On
new segment.
This is a new segment.
Sponsored by Duro Cleaning. Called Is It a Write-Off?
Is it a write-off?
Jerry, you want to start? All right, I'll start.
We'll let you go. You usually kick us off on these things, so we're not going to fuck up the batting order.
Okay. So just take them literally. And if you're not sure, I guess say maybe.
Yeah.
So Joe and I go to Miami. Can we write that off? Just going on a trip to an Airbnb and coming back?
To party?
Yes.
No.
What if Joe and I go and we look at real estate?
If you have legitimate meetings with real estate agents, you're going to look at properties. There are some write-offs that you can have for that trip. If that trip is a 7-day trip and you spent 2 hours looking at a building, no. If your trip is there and your intent is to go shop for real estate, you have meetings every day, you're actually doing things that you can document were for business purposes, then yes.
Okay. How about an addition on your personal home?
No. And on a personal side,
Even are we going to put an office in it?
No, not directly. On a personal income tax side, there are certain things that if you did that you can get energy credits, insulation, doors, windows, furnace, things like that, solar panels. On a business side of things, the home office thing is a tricky one. And I'll go into it. I'll try not to drag this out too much, but there's two different ways to do a home office expense. Okay. There's the old traditional way, and then there's the simplified method or the safe harbor method, which is it was more recently adopted. The old way was that you took the square footage of your whole house.
Wow.
You took the square footage of the office that you use only for your work. That doesn't mean your dining room table. And you take the percentage of the square footage for the office, and then you can take your utilities, your mortgage interest, your property taxes, your insurance, etc., and then take that percentage of those expenses, right? The downside to that is that you also have to take a depreciation expense. Okay, so they ask you, what's the value of your home? Well, it's $200,000. Okay, well then you're going to take $200,000 divided by 27.5 because that's the residential depreciation method. And then we're going to take that percentage of that depreciation every year. Now, it's a small expense, but the problem with that is that if you sell your house and it is not a business asset, it's your home, and you live there for 2 of the past 5 years, and you make a profit, and say you're married, and your profit was less than $500,000, that's tax-free. When you start taking depreciation expenses on that house, you're generating a tax liability when you sell it. So that deduction now might be nice, but when you go to sell your home, now all of a sudden you're paying taxes on the sale of your home to recapture that depreciation. Now, I've had people say, well, can we just not take the depreciation expense? Can we just skip that part? The problem is that the tax code is written that you have to report depreciation allowed or allowable, meaning whether you took it or not, you have to report what you should have taken. And that could end up with a problem down the road. So the safe harbor method, the new method, is you take the square footage of the room that you use primarily for work and you multiply it by $5. And it's capped out at 300 square feet, so $1,500. That's your deduction. It's not as good, but there's no long-term side effects. It's just a cleaner way. If you own your home, I try to push people to do that method, which means when you put the addition on your house, it doesn't matter.
Joe and I go to a strip club with our accountant, and while getting a lap dance, we discuss write-offs.
No. So part of the 2018 tax bill, they phased out the entertainment portion of the meals and entertainment expenses.
Senators.
Yeah. So you are still allowed to take half of meals when you take a client or a customer or an employee or something, business associate, to dinner. You can pay for dinner and you can deduct half, meaning the idea of that is me and you go to dinner for business. Yes. I'm not writing off my half. I'm writing off your half.
So
see, that's how the
entertainment
but if
is
we
not
have
deductible.
A meal there,
you can write off half the meal.
Yes.
But the entertainment portion of the evening,
yeah, the IRS realizes you can't share a stripper, so you can't split.
You can't split her in half. The show portion of your dinner and a show is not deductible, and that applies to season ticket holders. You know, there's a lot of people who bought season tickets at sporting events.
We talked about that before. Yeah,
can't take it.
GoFundMe donations.
Oh.
So a GoFundMe donation is a tax deduction to the donor.
Okay.
It is tax-free to the person receiving it. Now, the way they get away with that is, say, for instance, you had your friend set up a GoFundMe for you and you had $100,000. Now, to you, you just got $100,000. You think, I should have to pay taxes on this, right? Well, the IRS code allows people to give gifts of up to $16,000 a year. Chances are, none of those people that donated that made up that $100,000 gave you $16,000. So they're treated as individual gifts that are not taxable.
So why don't you just set up a GoFundMe for Landmark? And when people owe you for their tax bill,
well, because now you said it on air.
Edit, cut.
All right. I spend $1,000 on an NCAA bracket. I win $15,000 and I gift it to my wife.
No. So the gift is not a deduction. The only reason the GoFundMe is a deduction is because GoFundMe has it set up so that they're a charity. So it's a donation, it's a deduction as a charitable contribution.
What if I lose $20,000 during the tournament?
No. So here's how this works. So technically,
yes.
Okay, that $15,000 that you won
Yeah.
is taxable income. Now, however, if you have a gambling habit,
yes,
if you are habitually gambling, you can write off your losses to the extent of your winnings. Now, there's some weirdness with this. Now, I may have mentioned in a prior episode, I'm working on an audit, and there was some question about some gambling winnings. Now, I had a pretty in-depth conversation with the auditor about gambling write-offs because I found it interesting that he questioned the write-off. Now, there's a reason why casinos are so pretty.
Yeah.
Nobody fucking wins.
Right.
Okay. So most people, when they have a winning, I've got clients that'll show up with $400,000 worth of those little W-2s, right? And we write off every fucking one of them. Okay. Zero them out. Gone. Because nobody wins. Okay. Now, it's pretty much common accepted practice. And the funny thing is that I've also had a client that said, hey, I went to a church, carnival and I won a car. Do I have to pay taxes on this? Now, that guy won a $30,000 car, and I've got this guy over here with $450,000 worth of slot play wins. I'm writing off every dollar of that $450,000, but this poor guy that won a $30,000 car that never goes to the casino, he's paying taxes on that $30,000 because it has to be a pattern.
Price is right, dude.
Yeah. And a lot of raffles now, like there's a fire department that's doing $40,000 worth of Milwaukee tools.
Yeah.
Wow.
But they're also going to give you the cash
To pay the tax.
Nice.
Okay.
So, because in gambling, gambling's 24%, right?
It's just your ordinary tax rate.
Yeah.
It's not any higher. It depends on your tax rate.
But
That's why you have guys that, like, sometimes they'll win at the track and they call a guy a 10%er. They'll give the ticket to a guy that doesn't have much income and they'll go cash it in.
Well, that's what's screwed up too, is because you say about the casinos being so pretty, you could go there on a bachelor party, you could win $40,000. They're going to give you $40,000, and then you're going to have to pay the taxes on that. So if you go out with your buddies and you spend $20,000 again and you lose another 10, you're responsible still for the taxes on $40,000.
Well, yes and no. So at the end of the year, we're going to write it off and we're going to show that you lost all of that. So throughout the year,
you have to gamble
lost it
more.
all. Yeah, you have to gamble more.
You have to gamble to lose.
Yeah, you have to lose.
Okay.
But most people do. So I mean, it's never really been an audit item. The only reason it came up in this audit is because we were looking at other stuff and it just he questioned it, but he ended up being fine with us just writing it all off. So
okay, so I know you can write off your cell phones, you can write off your wireless internet and stuff like that. Yep. Skylink, the world, like it's world over. You can use it anywhere. It's like for like on RVs and shit.
Yeah.
If you elect to have Verizon Wireless traditionally and then have Skylink on the side,
yeah,
can you write that
off?
If
you need it, if it's part of your business and you need it to operate your business, then yes, absolutely. Mm-hmm. And you have to think too. I mean, I've gone through audits and there's things that they question. Sometimes they're small, but then there's things that are just not material. And, your cell phone bill, they're not going to sit there and be like, well, I want to see your cell phone bill and I want to make sure there's nobody else on that plan. Like, it's not material. As long as it's not an outrageous amount of money, it's not going to attract the attention. I'm not saying to
cheat
to cheat.
Well, I mean, they're not going to ask you, hey, you were at Home Depot and it was $67.82 and that candy bar on there. It's definitely not a deduction.
They're not going to go to that
because we pay enough taxes as business owners in other places.
And for something like that, if they saw a Skylink expense on your return and on your bank statement, there might be a conversation of why do you need that? But as long as you had a good reason why you need that, they're going to be like, all right, that sounds good.
Because Verizon Wireless sucks at my house.
Right. Like, I need it because I don't have good reception at my house, or I travel, I have to deliver dry cleaning, and a lot of times I'm in an area where I don't have signal, so I have to have this system so that I can communicate. That makes sense. Okay.
On to the next one.
Joe and I go golfing every weekend. We talk business.
Nah, that would be considered entertainment.
Yeah, they crushed that.
What about, I take my family to Ocean City,
Mm-hmm.
but I work remotely Monday through.
For a business or W-2?
I'm working on my website.
For the business?
Yes.
So, no, that would not be, because you're not there for work. You could be doing that
What
at
if
home.
I'm doing tile 9 to 5?
There?
Yep.
Yeah, then there's portions of that trip that are expensible. Now,
Okay.
going out to dinner with your family, I wouldn't do that.
Okay.
Staying down there so that you could do it, I would do that. I mean, the fact that your family is kind of hanging out with you while you're there, kind of a moot point, and probably wouldn't even come up on an audit. Like, well, were your kids there? They're not going to ask that.
Yeah.
Hey, I had a job in Ocean City. I had to go down and do tile work. That's the place I stayed when I was down there. That's the car I rented when I was down there. If you have documentation to show that you were down there for work, receipts from Home Depot, things like that, then they're not going to bother you for that.
Same would go with trade shows.
Correct. Conferences,
Yeah.
trade shows. Yeah, absolutely.
Cool.
Now, if I'm going to a conference in May,
Nashville?
San Antonio.
We're all going, right?
You can come. Yeah.
Yeah, I think we're going to write that one off as a team.
But my wife's not coming, but there was a thought that she might come. Now, I'm still writing off the hotel room, right? I'm still going to write off the conference itself, my airfare. I would not be able to write off her airfare. Right. So things like that.
Well, the trick is you buy one first class seat, write that off, and then turn that into 2 seats, general seating.
There you go.
I got to quit saying this shit on air. I'm going to get audited.
What about sales tax? Let's say I buy my wife a ring in Florida.
Yeah. So sales tax is on a business side, it's not. There's nothing that wouldn't be a business expense at all. But on a personal side, when you itemize on your tax return, you can take state and local taxes. Now, you can either take state and local income tax or you can take sales tax, whichever is higher. For the vast majority of people, state and local income taxes are
3%
higher.
3% or whatever.
Typically, especially when we live in Pennsylvania, you typically spend more in income tax, even though the rate's lower. But you'll see a lot of times retired folks that don't have because Pennsylvania doesn't tax pensions or Social Security, so those people have very little state and local income tax, if any. So a lot of times they'll defer to the sales tax expense, especially if there's something like they bought an expensive car that year.
Yeah.
If they can justify the amount of sales tax. Now, I could tell you I do a lot of returns, and I can tell you probably a couple dozen times in 17 years that we've actually gone through the effort of figuring out sales tax, because it's not very common that somebody would write that off.
Okay.
So if you said the entertainment thing kind of screwed things up.
Yep.
So if I, as a whole, sponsor a local charity golf outing, a lot of times what they'll do is they'll give you 4 members to golf in the outing. They'll give you meal tickets and the whole nine, but you got to write a $10,000 check.
Yeah, so that's a little bit different because they're going to put up signage, right?
Okay.
That's an advertising and marketing expense.
And you're getting a kickback.
Well, you're going as part of it, right? But you're sponsoring it. It's a marketing expense. Now you have to be careful between donation and sponsor and marketing and advertising, because a lot of times people will say, "Well, it was a donation." It's not a donation, and using the word donation is going to make it not deductible. So you have to be careful with that. So you don't want to use the word donation. Now, your donation to your church is not an advertising expense, but if you are donating to the church to get your business in the newsletter, then that is an advertising expense. So you have to figure out what are you actually promoting your business with this money that you're donating or paying for the sponsorship? If you are, then we can write it off as an advertising expense. But don't put it in your QuickBooks as a donation.
You get one more. Try to beat the tax man one more time.
Let's say you get two of your friends and start a podcast and promote your business and buy a bunch of equipment and advertise your business and bring business owners on.
Yeah. So I will tell you this. So, good question. Something that I'm navigating, right? So here's the deal with this. So just as a little behind the scenes, because most people watching would have no reason to know this, but I set up an LLC that we're all partners in called Between Two Bridges, and those expenses are going to be on that tax return.
Boom.
And will be written off. Now there'll be partner contributions based on everybody else's expenses, and that'll all be tracked or whatever. But it will be. This is
legit.
This is legit.
Yeah.
And hoping that someday it makes some money. Sponsors and maybe some ad revenue on YouTube or whatever. Social media revenue, things like that. But yes, this is actually a legitimate business that we're going to write off these things, and
we are going to report a significant loss this year.
Yeah, it's not. It's been a rough year, guys.
It hasn't been all
so we do know
bourbon and fun.
Yeah,
is the bourbon a write-off?
No, that's just us.
It's a gift.
That's just us acting like assholes.
Yeah. We might be able to spin it at some point.
Explain to the IRS that we needed it to loosen up.
So that's funny because when my wife did the candles with the beer bottles and stuff, I was like, we're acquiring these bottles to make product for her to sell.
Right?
Yeah.
Does
it work?
I don't think so.
No.
Okay.
Even if you buy beer for your employees like Friday, you can't write that off.
No,
that's entertainment.
Yeah.
Don't get me started, buddy.
I mean, that's being consumed.
Pay cash.
So that's the other thing too. Don't forget too, there's a difference between a meal whenever you're taking a client out versus a meal whenever you're buying pizza for your staff. If you're having, when I was in retail on a busy day, they always bought pizza for everybody. Everybody thought, oh, they're taking care of us. Fuck that. They don't want you to leave. They don't want you taking an hour-long lunch. They want you to go eat a couple slices of pizza and get your ass back on the floor.
Right.
That's a write-off for them.
Right.
It's 100% write-off because it wasn't like they were out to dinner with a client. They were feeding the staff. So I would venture to say I would write off that, like my first corporate job, they used to have beer Fridays.
Yeah.
That's
coming into an obligation though, because now you're openly admitting that you bought alcohol for people that are going to leave and drive home. So I guess it might not be worth the write-off.
Yeah.
We're not insurance guys, Joey. We're tax people.
Yeah, we don't worry about that. But what about if you bought like a whole cow of meat and distributed it amongst your employees?
I don't know, man. I mean, I think
not prepared, but food.
Yeah, I think that's we call it an employee benefit. Here's some steaks.
Because like a lot of companies used to give out Christmas hams.
Right?
Yeah,
absolutely.
That's a hell of a write-off. Buy 80 hams.
Yeah, I have a client that buys a truckload of hams and gives them out to people in the town that need it.
Yeah,
Angel Kuhn. She was on the show.
Maybe we could do that.
I have a competitor that gives out hams, and my people are like, "Can I get the $28?" Like, just give me the $28. I go buy a fucking ham.
Yeah.
So, well, that was fun.
Yeah, it's a good time to do it. It's tax time, so hopefully somebody got something out of it and
Reach out to Jerry for
more tax advice.
yeah.
But consult. Don't just take this and be
And
like,
run with
okay,
it.
I'm going to do my own taxes and I know everything now. Consult a tax accountant, and for the love of God, if you see something on TikTok that you're like, oh my God, I can write that off, talk to an accountant.
Yeah.
Like
Send Jerry your videos at all hours of the day.
yeah, I love that.
Yeah. I got real excited in my notes because we were taking notes and I saw Augusta and I was like, is this dude going to tell me we can write off going to Augusta? Because we're about to break the bank.
Entertainment.
Yeah.
We get media credentials, then that changes the game.
It does, because
So-
we're there for work.
So if we are at the U.S. Open in 2025 as media,
When we are at the U.S. Open.
when
We're not writing off our beers.
But we are writing off
we
our
are
houses.
writing off
We are renting our houses out though.
our clothes,
If
we have jerseys.
no, that's uniforms.
Team uniforms.
You can't so here. Okay, let's talk
Shirts.
about this. If we have uniforms that say Between Two Bridges,
Yes.
they're branded. Absolutely, that's a write-off.
yes.
If it's a shirt, if it's a uniform or a shirt that you can wear out, it is not a deductible expense. So it has to be branded. Or if you're like in construction and you're writing off your,
Hoodie.
construction clothing,
Yeah.
that's all just for work,
Okay.
then that's a write-off.
What about dry cleaning?
That's okay. Yeah,
Yeah.
I have clients who write off their dry cleaning.
So I had a client that was on the news and they said that because they get dressed in studio and only wear it on air, they can use it as 100% write-off.
As long as it's staying in the studio and
Yeah.
it's only for that, then I could see that. I can see that being valid.
Hmm.
But it's the
Perfect.
same thing with like what we talked about the other day with like, it's a new world we're living in. Like girls are getting their nails done and they're Instagram influencers, and that's a deduction because they're, hand models, or they're, doing their toes and selling their feet pics.
And they're going to pay enough income tax.
Yeah.
So
Right.
they deserve some write-offs too. Strippers are people too.
See,
That's right.
accounting can be fun.
Go to school to be an accountant.
Thanks, guys.
Thanks,
Oh,
guys.
you hit it for me. Thanks, bud.
Thank you for listening to Between Two Bridges, a business-to-business podcast. Find and follow us on your preferred podcast streaming platform. Like and subscribe, and leave us a rating and review. You can join us socially on Facebook, Instagram, TikTok, and Twitter. Yes, we still call it Twitter. You can email the show at info@betweentwobridgespodcast.com. Until next time, make it till you rake it.